Hello everyone, welcome to American Brief. And this week we got two of the biggest catalysts silver bulls have been waiting on for months, possibly years, arriving almost at the same time. First, growing signs that the war involving Iran is finally winding down, with ceasefire talk turning into something that looks a lot more concrete than the on-again, off-again rumors we have heard before. And second, fresh chatter out of the Federal Reserve suggesting that rate cut hopes for the back half of 2026 are very much alive again after weeks of the market pricing in the opposite. So the question everyone wants answered today is simple. Is that combination, peace in the Middle East, easing the geopolitical premium baked into commodities, plus renewed rate cut expectations, easing the pressure of a strong dollar and high real yields, actually enough to push silver into a genuine new leg higher in 2026? Or are we looking at another short squeeze that fades the moment the headlines change? That is exactly what I want to break down in this video, starting with what is actually happening on the ground with the Iran situation and why markets care so much about it in the first place. Then we will move into the rate cut picture, what the Fed has signaled, what the market is now pricing in, and why that matters enormously for a non-yielding asset like silver. After that, we will look at the technical picture for silver specifically, the levels I am watching, and where I think the real decision point sits over the coming weeks. And we will close out with my honest take on whether this is the start of something bigger or just another bounce inside a longer consolidation. So stick around for that, because I think it is genuinely one of the more important setups we have looked at this year. Before we get into it, I do want to say that days like this are exactly why having a clear framework matters more than reacting to every headline that crosses your feed. Markets move fast on news like this, and the temptation is always to chase price after it has already moved. So keep that in mind as we go through the analysis, because the goal here is not to get you excited about a green candle. It is to help you understand the actual mechanics driving silver right now, so you can make decisions you are comfortable with, regardless of what happens over the next few days. So let us start with the geopolitical side of this, because that is what moved first. For months now, the conflict involving Iran has acted as a kind of floor under precious metals and a ceiling on risk appetite more broadly. Every time tensions escalated, we saw the classic flight to safety trade, money rotating into gold and silver, oil spiking on fears of disruption to shipping lanes and production, and equities wobbling on the uncertainty. That fear premium has been a real and measurable part of the price action in metals this year, and it is one of the reasons silver has been able to hold up even during stretches where the dollar was strong and real yields were elevated, two conditions that normally weigh heavily on precious metals. Now, with reports suggesting that back-channel negotiations have produced something closer to an actual framework for de-escalation, rather than just another temporary pause, the market has to start pricing out some of that fear premium. And this is where it gets interesting, because the knee-jerk reaction from a lot of traders is to assume that less geopolitical risk automatically means lower metals prices, since you are removing the safe haven bid. That is true on the margin, and we did see a little bit of that reflexive selling in the immediate aftermath of the news. But it is only half the story, and I think people who stop their analysis there are missing the bigger picture. Because here's the thing. The end of an active conflict, or even just a credible step toward one, does not just remove fear from the market. It also removes a major source of inflationary pressure tied to energy prices. Oil has been one of the stickier inputs into headline inflation this year, and a meaningful de-escalation that takes the risk of supply disruption off the table could see crude prices ease in the weeks ahead. Lower energy costs, feeding through into lower headline inflation numbers, gives the Federal Reserve more room to justify the rate cuts that markets have been begging for, which brings us directly into the second half of this story. So, in a strange way, peace in the Middle East and rate cut hopes are not two separate catalysts working independently. They are actually connected through the inflation channel. And that connection is a big part of why silver has been able to shrug off the initial knee-jerk selling and stabilize fairly quickly. Now, let us talk about the rate side of the equation, because this is where I think the more durable part of the silver bull case actually lives. Coming into this year, the market had priced in a fairly hawkish path for the Federal Reserve, with expectations for just one rate cut, if any, given sticky inflation readings and a labor market that kept surprising to the upside on the jobs numbers. That repricing put real pressure on metals earlier in the year, because higher expected rates mean higher real yields, and real yields are one of the cleanest inverse relationships you will find with gold and silver. When the opportunity cost of holding a non-yielding asset goes up, money tends to rotate into bonds and cash equivalents instead. But what we have seen over the past couple of weeks is a meaningful shift in that pricing. Fed officials have started talking more openly about the lagged effects of policy finally showing up in softer corners of the economy, and there has been more willingness from voting members to discuss the idea of one or even two cuts before the end of 2026 if the data continues to cooperate. Combine that with a potential inflation relief coming from lower energy prices if the Iran situation continues to de-escalate, and you start to understand why the market has moved fairly quickly to reprice rate, cut odds higher. This matters enormously for silver specifically, even more than it does for gold in some ways, because silver carries that dual identity as both a monetary metal and an industrial one. On the monetary side, it behaves like gold, responding to real yields, dollar strength, and central bank policy expectations. But on the industrial side, silver is deeply tied to manufacturing activity, solar panel production, electronics, and a whole range of applications where demand is sensitive to the broader economic cycle. A scenario where the Fed starts cutting rates because inflation is cooling in a healthy way, rather than because the economy is falling off a cliff, is actually a fairly ideal setup for silver, because you get the monetary tailwind of lower real yields working alongside a relatively stable industrial demand picture instead of a recessionary one that would hurt the industrial side of the equation. That is the soft landing scenario that silver bulls have quietly been hoping for. And it is starting to look at least plausible again after a stretch where it felt like that window had closed. Of course, I want to be balanced here, because nothing about this is guaranteed, and we have seen false starts on both the Iran situation and the rate cut narrative before. Ceasefire talks have collapsed before. Rate cut expectations have been walked back by hawkish Fed speakers more times than I can count over the past couple of years. So treating this as a done deal would be a mistake. What I am saying is that the probability-weighted outcome has shifted meaningfully in a direction that is constructive for silver, and that is worth paying attention to even if it does not play out perfectly in a straight line. So let us bring this back to price and look at what the charts are actually telling us, because narrative only gets you so far without confirmation from price action. Silver has spent a good part of this year working through a wide consolidation range, and the recent move on the back of this news has pushed price up toward the upper end of that range without yet making a clean break above it. That is an important distinction to make, because there's a real difference between a relief rally inside a range and an actual breakout that confirms a new trend. I want to see silver hold above its recent breakout attempts on a weekly closing basis, not just an intraday spike, before I start treating this as confirmation of the next leg up. On the downside, if this rally fades and the geopolitical or rate cut narrative stalls out, I would expect silver to find support back near the lower portion of that consolidation range, an area that has been tested and held more than once already this year. That level matters because it represents where buyers have consistently stepped back in, and a clean break below it on heavy volume would tell a very different story than the one we are discussing today. What I am watching most closely over the next few weeks is not just price, but the relationship between silver and the mining stocks, because historically, strength in the miners ahead of strength in the metal itself has been one of the more reliable, forward-looking signals we have seen in past cycles. If we start to see silver miners outperforming the metal on a relative basis even during choppy price action, that tends to suggest that money with a longer time horizon is positioning ahead of an expected move, rather than just chasing headlines. I will be tracking that closely and will update everyone here if that signal starts to flash, because it has historically given an early read before the bigger moves in silver itself. I also want to touch on the dollar, because it ties everything together. A meaningful de-escalation in the Middle East, combined with rising rate cut odds, is a combination that tends to weigh on the dollar over time, since lower expected yields make dollar-denominated assets relatively less attractive to foreign capital, and reduced geopolitical risk lowers the safe haven bid that the dollar sometimes benefits from during periods of conflict. A weaker dollar is generally a tailwind for commodities priced in dollars, silver included, so this is another channel through which these two catalysts reinforce each other rather than working in isolation. Keep an eye on the dollar index in the weeks ahead, because sustained weakness there would add another layer of confirmation to the bullish case for silver. Before moving on, I think it is worth putting this moment into some historical context, because markets have a short memory, and it helps to remember that this is not the first time we have seen geopolitical de-escalation and shifting rate expectations collide. Go back and look at past cycles where a major conflict wound down while a central bank was simultaneously pivoting toward easier policy, and you will notice a pattern. The initial reaction in commodities is often choppy and even slightly negative, because the safe haven bid unwinds faster than the rate cut benefit shows up in price. But a few weeks later, once the market has had time to digest the inflation implications of lower energy costs, and the dollar starts to soften on reduced rate cut hesitation, that is typically when the more sustained move begins. I'm not saying history repeats exactly, because every cycle has its own quirks, but the sequencing tends to rhyme. And it is one of the reasons I'm not overly concerned about the choppiness we saw in the first day or two after this news broke. I also want to spend a moment on positioning, because that matters just as much as the fundamental narrative. Coming into this news, A lot of the speculative length in silver futures had already been flushed out during the earlier stretch of hawkish rate repricing, which means there was not nearly as much weak hands length sitting in the market to get shaken out on the initial pop. That actually works in favor of the bulls here, because rallies that start from a position of lighter speculative crowding tend to have more room to run before they become vulnerable to profit taking, compared to rallies that start when everyone is already maximally long. So part of what makes this setup interesting is not just the catalysts themselves, but the fact that they are arriving at a point where positioning had already reset to a more neutral state. On the level side, I want to give you a bit more detail than I usually do, because I know a lot of you are asking for specific numbers to watch rather than just a general direction. The range I mentioned earlier has a well-defined lower boundary that has been tested multiple times this year and has held each time, and that is the level I would consider the line in the sand for the bullish case staying intact on a medium-term basis. A daily or weekly close below that level would tell me the rally has failed and that we're more likely heading back into a deeper consolidation rather than the start of a new leg higher. On the upper end, there's a resistance zone just above current price that has projected multiple rally attempts over the past several months, and a confirmed close above that zone, ideally on strong volume and not just a quiet drift higher, would be the cleanest signal that this move has real legs behind it. Until we get one of those two outcomes, I think the right approach is to treat this as an important test rather than a confirmed breakout, and to size positions accordingly rather than assuming the outcome in either direction. Now, I want to get into a viewer question because I always like to feature one from the comments section, and this week a few of you asked variations of the same thing, essentially wanting to know whether it makes more sense to wait for a pullback before adding to silver positions, or whether the setup is strong enough to justify buying into strength right now. My honest answer is that it depends heavily on your time horizon and how you are already positioned. If you are someone with a multi-year view who is comfortable scaling in over time regardless of short-term volatility, the case for continuing to build a position methodically does not really change based on a single week of news, even good news like this. Dollar cost averaging through periods like this has historically rewarded patient buyers far more than trying to perfectly time entries around headlines that can reverse just as quickly as they appeared. If you're someone with a shorter time horizon looking for a tactical trade, then I would be more cautious about chasing the initial pop, and would rather wait to see whether silver can hold these gains on a weekly closing basis before committing meaningfully to a short-term position. Neither approach is wrong, but it is important to know which one you are actually following, because trying to do both at the same time is usually how people end up making emotional decisions at the worst possible moments. Stepping back and looking at the bigger picture, I think what makes this moment interesting is not that either catalyst on its own is enough to change the long-term trajectory for silver, because honestly, the long-term case for silver has always rested on bigger structural forces, things like persistent government deficits, central banks diversifying away from the dollar, and a genuine supply-demand imbalance in the physical market that has been building for years now. What makes this moment interesting is that we are seeing two short and medium-term catalysts align in a way that could accelerate a move that the longer-term fundamentals already supported. That is a meaningfully different setup than relying purely on a geopolitical shock or purely on a single Fed meeting to do the heavy lifting. When you get multiple tailwinds pointing in the same direction at the same time, that is usually when you see the more durable moves in this market, as opposed to the sharp spikes that fade just as quickly as they appeared. So, to bring this all together, will the end of the Iran war and renewed rate cut hopes be enough for silver in 2026? My honest take is that neither one in isolation would likely be enough to drive a sustained new leg higher, but together, working through the inflation channel, the real yields channel, and the dollar channel all at once, they represent a genuinely constructive setup for silver heading into the second half of the year. I'm not getting ahead of myself and calling this the start of the next major breakout just yet, because we still need price confirmation, and we still need to see whether both of these narratives hold up over the coming weeks, rather than reversing the way we have seen happen before. But I will say that the probability of a more favorable backdrop for silver has clearly improved, and that is worth paying close attention to if you are someone who has been waiting patiently for conditions like this to line up. I will continue tracking both of these stories closely, and will bring you updates as soon as there is meaningful new information, whether that is further developments on the Iran situation, comments from Fed officials, or confirmation in the price action itself. So with that said, I want to thank you all for watching this video. If you found this breakdown helpful, please consider leaving a like, as it genuinely helps this channel reach more people who might benefit from this kind of analysis. And as always, drop your questions and thoughts in the comments section below, because I do read through them and like to feature viewer questions in future videos. Thank you all again for being here, and I will see you in the next one.